board to order for Tuesday, June 29, 2021. The first item on our agenda always is to officially call the roll. Please do that, clerk.
Dr. Ketchel,
Yes.
Mr. Vanderwilly,
Yes.
Ms. Gaines, she is absent.
We have a posted agenda, which we will follow. There's a couple of them that involve telephone, so we'll deal with that with the device on the table there. We also have several that the board has been informed that the assessor staff have worked out agreements on them, so we're going to take them first, just to get them out of the agenda. Then after that, we'll proceed with the agenda the way it's ordered. So, from the Tulsa assessor's staff, who's going to talk about the agreements with the board.
I have 4 of the agreements,
Okay.
and Zach will have 1.
And officially introduce yourself to the tape.
My name is Tracy Conley with the Tulsa County Assessor's Office.
Tracy, give us the 4 agreements that you have.
For formal appeal 2021-001344
Yes.
with GPM RE LLC, we have an agreement of $355,000.
355,000 as the fair market value on this property. I so move by agreement. Is there a second to my motion? Second. It's been moved and seconded. We'll vote as the roll is called.
Dr. Ketchel,
Yes.
Mr. Vanderwilly,
Yes. This is the fair market value as voted by the board this day by agreement. All right, Tracy, please continue.
Okay, with a formal appeal number 2021-001347 with GPM RE LLC, we have an agreement of $732,000.
732,000 as the fair market value by agreement. I so move. Is there a second? Second. It's been moved and seconded. We'll vote to make this fair market value by agreement official. Please, clerk, call the roll.
Dr. Ketchel,
Yes.
Mr. Vanderwilly,
Yes. This is the fair market value by agreement. Tracy, please proceed.
I'm passing to Zach for this next one.
Okay. Zach, identify yourself for the tape, please.
Zach Blay, Tulsa County Assessor's Office, for appeal number 2021-001392.
Oops, just a minute. My thing was, I was handed 1492. So you want me to do 1392, is that it?
Yeah.
All right, I got it.
Perfect.
And the agreement is
Yes, we have agreed to a value of $1,820,000.
1,820,000 by agreement as the fair market value. I so move. Second. It's been moved and seconded. We'll vote as the roll is called.
Dr. Ketchel,
Yes.
Mr. Vanderwilly,
Yes. This is the fair market value by agreement. I do this one now, huh? What happened to that?
no,
Okay. Now, I'm ready for protest number 1419. Is that?
Yes.
Tracy? Yes. What is the agreement?
Tracy Conley with Tulsa County Assessor's Office, formal appeal 2021-001419. We have an agreement of $8 million.
$8 million, even as the fair market value by agreement. I so move. Second. It's been moved and seconded. We'll vote as the roll is called.
Dr. Catchell,
Yes. this
Mr. Van
is-
Willen,
Yes. That's all right. This is the fair market value by agreement. You never know what I'm gonna do, do you? That would go past the phone hearings. Now, you got number,
got something 1436.
then the other one, you thought we kind of gave it on.
What's your
was
next one?
15, 15.
Okay.
You got that? Yes. All right. Please, Tracy.
Formal number 2021-001519 with the F&M Bank and Trust Company. We have an agreement of $1,640,000.
$1,640,000 by agreement. I so move. Is there a second? Second. It's been moved and seconded. We'll vote as the roll is called.
Dr. Catchell,
Yes.
Mr. Van Willen,
Yes. This is the fair market value by agreement. That takes care of 5 items from today's agenda. Now, as I understand it, we're going to item on my agenda 1436 and 1494, Reunion Investment Limited. And then Van Rivers Loss LLC. Are you the assessor staff on these? Okay, thank you. And yeah, why don't, gentlemen, we're going to speak to this first one on our agenda, which is Reunion Investments Limited. As I understand, you also need the telephone call at this time.
Yes,
Okay, here comes the clerk. She'll do that for us.
Good afternoon, Southwest Tax.
Good afternoon. Is Chance Williams there?
Yes, may I tell who's calling?
Of course. This is Ted Catchell. I chair the Tulsa County Equalization Board, and he has a share in an appeal to the board today.
Okay, one moment.
Southland Property Tax Consultants, recognized as the premier provider of commercial property tax solutions in Texas for more than 30 years.
Texas. What? Is this Chance Williams?
Yes, this is him.
This is Ted Catchell. I chair the Tulsa County Equalization Board. And we're here to hear an appeal that you are a share in. That is the Reunion Investments Limited. Is that correct?
That's correct, yes, sir.
Okay, I'm going to ask your colleagues to introduce themselves now for the record, please.
yes, Timothy Rogers, on behalf of Reunion Investments.
And
Scott Woolbrock on behalf of Reunion Investments.
all right, thank you. The way I usually do this is I'll read what I've got in the formal statement, and then you add anything you want to, and then after that, we give the staff or the Tulsa assessor a chance to speak to the same issue. All right, what I have here is that was previously on for $12,748,500. After the informal, it was reduced to $11,078,000. After that, you and your client appealed and said you thought that was still too high and you wished for it to be corrected to a value of 8 million for the following reason. Property is unequally appraised with similar properties in the area. Property net rentable area is overstated in Tulsa County assessor records. Property had significant vacancy on 1/1/21. Property operated at a net loss in 2020. Pro forma income approach indicates a lesser value than the Tulsa County assessor's adjusted value. All right, what would you like to add to that?
This is Tim Chance. I'm gonna go first and I'll let you jump in if that's okay. Yeah, Reunion's position is the net leasable area, net rentable area is 80,054, which is reflected in the building plans and a rent roll summary in the packet before you, pages 7, 11, 12, and 13. Unfortunately, I don't believe the packet has page numbers on it, but
You said it was 7, 11.
12 and 13.
Okay, give me a moment here. See if I catch up with you.
Third page, perhaps will be helpful. There's a. It's actually, right on the packet. It's on the 7th page. It's a rent roll summary.
Yes, I'm looking at the rent roll summary now.
There'll be a common area summary and a gross building area summary. So the gross building area is 94,442. We subtracted the common area summary of 14,388 to get to a net leasable area of 80,054.
I see that, yes.
That's, I don't believe we have time, but that's supported by the drawings that are attached later on in the packet, 3 consecutive pages.
That's fine. No, we're okay.
Okay, and
If
the,
I get lost, I'll speak up.
okay, that's great.
Yeah.
The year-end 22 income, or year-end 2020, the property, 61% of the property's net leasable area was leased and producing income. That is reflected in the verbal summary. The ninth floor of the building is a unit and a residential unit all combined together for a live-work space. So it's not separate rentable areas. The basement is mainly common area space, and there's some small storage units that rent anywhere between $100 and $280 per month. January 1st, 2021, there's roughly 4,485 square feet in the first floor was still under construction, and there's no electric and therefore wasn't able to be rented. I'll run through the 2 approaches that support our valuation of our opinion that's 8 million. Of course, the direct cap income approach did not work on this property because the had a negative not net operating income of 379,000. That's reflected on the 3rd page of your packet. We next page be the 3rd page, yes. Yes. And below the direct cap income approach is the pro forma income approach I will speak to. Shows a potential gross income of 1.3 million. It shows actually vacancies are 42% under this pro forma. It's 19% with a collection loss of 264,000. There are deductions for operating expenses that are actually lower than the operating expenses for 2020. Gives us an operating income of net operating income of 661 with a 7.25 cap rate and deductions for business personal property and lease up deductions for the apartments, retail, and storage that are the 3 pages following the page you're currently on. We believe the value, the pro forma income approach supports a value of 8.147 million or 101.77 cents a square foot. The very last approach that we ran is the very last page of your packet. It's a comparable equity analysis that has comparables to the nearby property. You can see that the first line item is the Reunion property. It's currently valued at a gross building area square foot of $117.20 and $138.38 square foot for net leasable area. Running a median of the nearby and comparable properties here in downtown gets us to a net leasable area of $87.14. Mr. Williams did some adjustments to that calculation based on location, effective age, and size, arriving at a median net leasable area of $95.85 for the comparables. Supporting Reunion's position of $8 million would give Reunion's building a net leasable area of $99.93 per square foot, which is above the median and on the higher end of the properties and comparables downtown. With that chance, I'll throw it to you, Mr. Williams, if you have anything to add that I may have missed.
I don't have anything to add to that. I think that covered everything, unless there's any specific questions.
As I understood your presentation, at the very beginning, you said that you only thought the approach was this income approach to determining current value. Say again the reason you said that was your conclusion. I remember you saying some very specific thing, and you weren't referencing what this year may have been referencing, which was COVID. But what was it was a very specific thing you said at the very beginning. This is the only way we can do it.
Yeah, I believe at the beginning I was referencing this direct cap income approach.
Yes.
Actually, last year, the building had a net operating income of negative $379,000. So couldn't use that valuation to try to support.
All right. That was the only kind of question off the top of my head as I listened to your presentation. If you could, I don't think I was looking still for the comparison ones you were talking about. Can
Yes.
you help me find that? And
Yes,
just
sure.
state in a summary way what your
Yeah.
conclusion
It's
was
the,
in that comparison?
It's this page I'm holding up here.
Okay,
It's
good, graphic.
the very
Yes.
last page. And so if you look at the very top line item, it says the Reunion building, the subject is, and currently it's got a gross building area square foot of $117.30 and a net leasable area of $138.38. Running the 7 comparables nearby that were reflected on the map at 1 through 7 on the equity analysis shows a median of $87.14 per square foot. Mr. Williams then did some adjustments on these valuations on location, effective age, and size, mostly in an upward fashion, getting us to a adjusted net leasable area of $95.85 as the median for the comparables downtown. The Reunion's opinion, the valuation of $8 million for the market value would give it a net leasable area of $99.93, which is above the median and in the higher end of the 7 buildings listed there.
Okay, got it. I'm just trying to look at those so I have a sense of what you're using. And yours is a mixed lease building. Obviously, you're dealing with both apartments and commercial spaces. And was there some retail? I think you said there was.
Yes, there is some retail components to it. I understand it was not leased as of, or a very small percentage of it leased out of January
Okay.
2021. But
That's
there'll
fine.
be a breakdown packet on the percentages, and I can direct you to that.
Okay. Those were the only kind of off the top of my head questions. Charles, did you see anything you wanted to ask about?
Well, I don't know if it's a question or a comment. The assessor values the 12,748,500.
Actually, after the informal, they had reduced it
Went
to
to the
11.
11,078,000, is that
So
right?
there's still about 3 million.
Yeah, and you're wanting another 3 million off of that.
Correct.
How old is this property?
Originally built in 1919, and then we just recently completed a tax credit renovation. We completed construction in December 31st.
And I'm sorry, I just didn't hear you.
We recently completed a renovation of the building.
Okay.
I believe we got our certificate of occupancy January 14th, 2020.
And was that a complete redo or was there?
So the first floor, there are some retail spaces. Two of them are occupied. The unoccupied, as we mentioned earlier, was completely gutted and had no electric as of December 31st, 2020. We renovated the rest, completely gutted the rest of the building with the exception of the ninth floor, which was a personal residence and law firm, which we list as a live workspace, and that remained intact through construction.
But and so I should understand that you renovated, but your lease up is still less than 100%. Is that right?
That is correct.
What was that percentage? I've just forgotten.
We were at 40% leased, I believe, with 60% vacancy.
Okay,
Yes, 61. I have 61% of the property was leased. Is that
right,
correct?
60.
Yeah, so we're 40% occupied and 60% vacant, right?
I think 60% occupied, 40% vacant.
Oh, was it? Okay,
Yeah, is that correct, Chance?
okay.
Yes, that's reflecting.
Yes.
And in terms of that, do you have a breakdown in terms of what's an apartment, commercial spaces? How did it break down?
Yes.
Parts you at least out so far?
There's a third page, there's a real summary that shows apartments, percentage occupied was 58%. The live workspace on the ninth floor that we referenced was 100%. Retail was 47%. Storage was 64%.
All right. Charles, other things?
Yeah, maybe a bit philosophical, but how old is the property?
It was originally constructed in 1919.
19.
It's over 100 years old, and then we recently completed the tax credit renovation of the building.
The assessor has a 12,748,000.
I think it's 11,078.
He brought it down.
Oh, okay, the 11,078.
Yeah.
You're asking for $8 million.
Yes, Mr. Goodwin.
And you're basing, as I understand, Charles, you asked the question the way you want to. And as I understand, what you're saying is that's our current economic performance. That's why you only did the income approach in this sense.
The pro forma income approach based
Right.
on how the building's going to perform is supports that, and also the comparables is two models we used.
Yeah. Okay, so that's where they're going in terms of trying to justify that they should not be doing the 11 million as their assessment because of that poor economic performance in general.
Yeah, the accountant side of me, my run through on this was assessor had it at 12,7, went to 11,078, and you're asking for 8 million.
Yes.
The first pass through, you were asking for 37%. I mean, literally going from 12,700,000 down to 8 million that you're asking for. That's a 37% whack. Is it a viable property? Is it?
My understanding is yes, once it gets leased up, as of January 1st, there was significant vacancies, and that's why the income was not there.
And when you talked about that $300,000 loss, was that basically because you were in there renovating and couldn't rent it out at that time?
Yeah, the operating loss was due to the vacancy we had in the building as well as some construction costs that we were incurring through the lease-up process.
Charles, that was the only other one that I had kind of popped into my mind just then.
Can you survive at an $8 million property or? Can it make money?
Hopefully it is, once it gets leased
Apparently
up.
it has sometime in the past.
Yeah,
I mean, it was largely unoccupied when you guys took it over correctly.
right, yeah.
So.
Were you a recent purchase, I guess, where that may be the thing we're missing here?
But the purchase took place in 2017, and then we just recently completed the renovation.
Renovation, yeah.
I guess we'll take them move a little bit. Those are some big numbers trying to step around.
We're gonna hear what the assessor has to say about it, those numbers and why they disagree, obviously, and held on to the current 11,078,000. Please identify yourself to the board. And we'll go for it.
Thank you, Dr. Catchell. Sarah Alcock, Tulsa County Assessor's Office. I have a presentation to share with you.
Okay. Have you shared this yet with the owner and his tax
I
reps?
have not, and I
Okay,
can do so right now.
okay, thank you. And certainly we'll let her give her presentation, but as you watch and look through that, note anything that you're going to want to ask her questions about. And we'll certainly note anything we need to ask her questions about. But that's what we're here to do. Okay, please, Sarah.
Okay, so just a little bit on the property details. As it was mentioned, the improvement was built in 1919 and remodeled by the end of 2020. I take it by December 31st, as the gentleman noted, the renovation was complete, having received the certificate of occupancy in January. Now, the original 2021 fair market value was $12,748,000. We reduced at the informal level to $11,078,000. And you'll see as we continue on in my pro forma, the reason for the reduction was consideration for the current performance of the building as of January 1. And I'll break that down for you at some point later. The taxpayer requested value in 2021 is $8 million. This is 80 units, apartments, Class A structure. The mixed type, as was mentioned, the basement storage space, rental, the retail is on the first floor / office, I think. Apartments are on the remaining floors. Here's a photograph of the exterior of the building and the rooftop. It's available to tenants. Second page is simply just some photos of the interior to give you an idea of the finish. It's quite the high quality of finish that you would expect in a Class A apartment high-rise building downtown. It's highly comparable to some of the other properties that have been doing these types of renovations and that are garnishing higher rents in the CBD district. Okay, so if we turn the page, I have my pro forma listed out here, and what I've done here. Now, I know Mr. Rogers mentioned early on in his presentation that the income approach would not apply in this case because of a negative NOI. I disagree with that. I think we can build it from a point of stabilization and proceed on down to grant discounts for the fact that it's not completely leased up.
I thought he didn't rule that out, that he did an income approach, but his was pro forma and you're getting ready to do a pro forma. But wasn't that right? Didn't you do an income approach? Yeah.
Correct.
He just didn't want to do the capital work approach. That was.
Oh,
That
gotcha.
was his
Okay.
problem.
Okay.
Okay,
So-
go ahead.
What I've done is really, what I've done is based on my own research, but also with, in comparison to his pro forma approach here. Our potential gross income, I have derived of that from some of the documents and financial information rent roll that was provided to us at the informal level. Now, the potential gross income I have here would be representative of the market gross income based on all stories of the building being finished out, everything potential, okay? So, and my PGI was so close to his that I wound up just using his PGI from his income. We're pretty much in agreement on that. I have with vacancy and collection, I'm using sub-market data here, just in interest of fairness to other similar properties in the area. About 15% on vacancy loss and collection. I think on his pro forma, we're averaging 17%, so we're pretty close there. So that leaves our effective gross income at $1,161,978. We're fairly close on that number. He's about 1.1 and I'm about 1.1 million. I have in the market expenses section in the middle here in my pro forma, I have assigned actual market expenses, not what's actually going on, because we can't use actuals in here for our purposes. We know that we're trying to reach a value in our pro forma based on market parameters, as we're required to do for assessment purposes. So according to market expenses parameters, the bottom line net operating income comes to 876,789. Okay, and I think we have a general agreement on the cap rate. I'm at 7.18, he's at 7. I've loaded that cap rate. We have a market value of $12,211,545. Now, we have to think of that market value as stabilized, meaning everything is rented, everything's ready to go. You have market parameters applied to vacancy, and you have a full first floor, retail rented out and occupied. So I've taken business personal property as they've declared at $585,000 off of that. We have a market value then of $11,626,545. I have used Mr. Williams, the original tax rep I heard the informal with, submitted on his pro forma the lease up deduction for apartments, retail, and storage. I granted that deduction here at the bottom at $445,000. That is consideration, in my opinion, for the cost or the loss to lease on the first floor retail and the apartments, that having only at the first of the year, only having 65% occupancy as compared to a market of about 85%. So I'm using his numbers there. And my final value conclusion is $11,181,545. Now, once things are leased up, the stabilized value is going to push more up to this 12.2 million, as indicated on this pro forma. But I don't have any problem giving a lease up deduction. I agree with his estimation on that on his pro forma, and that's why I lowered the value to $11,078,000. Now, on the next page, did anybody have any questions? Did you have any questions about that?
I just wanted to make sure that I heard you say that when you were putting the market expenses together, you were not using the actual numbers he gave you.
I am not using actual numbers because I'm trying to derive a stabilized value and then give them a discount according to their pro forma and their estimation of the discount that should be applied for the lack of stabilization. Does that make sense?
It does make sense. I'm just trying to get the differences in the presentation.
Okay. Well, with mass appraisal and in terms of mass appraisal and assessment, we have to stick to market parameters. We are not using actuals. And the reason for that is always because in the interest of fairness and equity to other property owners in the area of this similar liking type. Okay, so the next page is.
I'm sorry to
go ahead.
interrupt, but I'm just trying to make sure I understand the point. I think I do, but like when he shows us all those other downtown properties, he wants to compare those to what are you saying that by you using the market expense that you can find that that's the way you compare it to those other properties? In other words, you're not using, you don't have access to their actual expenses downtown. Or you, even if you did, you wouldn't use them. I'm just trying to clarify that.
Correct. We do not use actual expenses even if we are provided them, because there's so many variables involved with actual expenses on the property. It could be it's in a period of lease up. It could be it's in a transition of ownership. It could be that it's in a period where they're investing a lot in capital improvements on the property, which is not allowable as a deduction. There could be a management problem, an overspending problem.
Yeah, right.
So there are a whole lot of variables. What we like to do is stabilize by using market parameters and giving everyone the opportunity. And the market parameters that we use, you'll see on the last page here, I've listed for reference only.
Yeah.
I mean, they're derived from thousands of apartments like that type in the Tulsa and Oklahoma City area. So what I'm doing is drawing on basically what you would call the median expenses for these types of properties. It should fall typically in line with those expenses as fully stabilized. And I'm doing a pro forma here as fully stabilized, so I need to use those market.
And that would be the other, I'm just trying to, again, for me, to note the differences, and what they did was the actuals. You didn't. What they did then was, what was the other thing you just said, that you had to stabilize, and they were still operating with what had been their experience in the previous years while they were going through the rebuild.
Yes, exactly. When a property is finished with its renovation, as they stated at the, basically by the date of taxable situs January 1, when it's finished and occupiable by a tenant, at that point, we are required to place value on it as stabilized, as if it were occupied. And again, that's the reason we do that is because we can't partake in any kind of impartial viewpoint according to what might be going on with their expenses or anything like that, or the status of the property, because by our office definition of stabilized is that it's ready to be occupied as of January 1. And this property, the first floor retail, all of the apartments and the basement were ready to be occupied. So that's how I have valued it. However, I did give it a discount.
Yes.
As you can see, because I feel like that's so, they were as of January 1 in the middle of trying to find a tenant. So here on the next page, I have rent comparables. You'll see some photo comparisons. So you can see that the exterior builds are very, very similar. All the locations are very similar. A few of these are highly comparable. 111 Lofts, namely, has been very recently renovated, 2019 and 2020. And to the side here, what I've done is listed each one of these properties as they're pictured with the price per unit that we have, market value currently. So Reunion Center is at the top here as the subject property at $138,475 a unit. And you can see how the spread falls here, somewhere between 126 and 203,000, with the median value being in the 130s on this property. That's another indicator to me that, we have this property value exactly where it needs to be for its current condition. I I know that the tax rep has put forth quite a bit of information on net leasable area, gross building area, estimates and comparisons. I wasn't able to verify. I have this sheet and I've had it since the informal. Per assessor records, I haven't been able to verify the dollar per square foot on these properties to be the same as what's listed here. I had to, because I didn't find this information reliable, I had so much conflicting information on assessor records. I had to just not consider this.
And when you say the assessor records, you're saying that in your records as of your previous assessments on those other buildings, is that what you're saying?
Yes, sir. I simply wasn't able to take the GBA, for instance, and come up with $134.99. Came up with a pretty much totally different number than that on all of these properties. So I don't know where the difference is coming from. I'm not sure. All I know is I'm looking at our record of gross building area and simply taking those square feet, dividing it by the market value. And my numbers are way different than these. I just simply couldn't use this information. What I could use was their income pro forma, which mine lines up almost identically in every important aspect of that when we're looking at it as stabilized. And then I could use these equity comps where we're looking at the price per unit lining up in the 130,000s as a median. So in conclusion, the assessor opinion of value is to request the board to sustain at $11,178,000, supported by my pro forma, the equity comps as stratified. The building permit also issued for this renovation was in excess of $14.8 million. It's hard for me to reconcile a $15 million investment on top of the cost of the property initially, resulting in a property that's valued at $8 million.
All right. John, your turn again.
Yes, I think, Mr. Williams, can you respond?
Yeah, absolutely. And Sarah, thank you for that information. I did have a quick question for you, if it's okay for me to ask, regarding the equity analysis and that not lining up with your records. I've pulled that information from the Tulsa County Assessor website in terms of the gross building area and net rentable area for each individual property. Is a discrepancy you could point out, and did you have your own kind of comparison between the properties that showed something different than what I had?
Well, thank you for that question. I'll address the board on that. All I can say, I can just say again, what I did was went through and checked each of these accounts individually, calculated the GBA according to our records against the current market value. And I was coming up with different numbers by as much as 20% difference per square foot on some of these. So what I didn't do was calculate my own tables based on our records, because I feel that my income pro forma, given the fact that our numbers line up so closely to your pro forma as stabilized, and I'm using the numbers that you gave me as the discount for lease up on the property, I didn't feel it necessary to to give an estimation on my part of square foot GBA or NRA. That's not how we typically value these types of properties, so it just wasn't something that occurred to me as necessary.
Okay. Well, it sounds like based on the assessor's testimony that the largest difference is really just the operating expenses that the property would incur in terms of developing a pro forma income approach value. You know, in the packet on, I believe, the third page, we've given what the property actually incurred in terms of operating expenses in calendar year 2020. That was $7.08 a square foot, or $567,000 in operating expenses. You know, we've tried to give some allowance to any extra or additional expenses incurred during the redevelopment process. When looking at the pro forma, we lowered those quite a bit, lowered the operating expenses quite a bit in the pro forma to $440,000, so about $137,000 less than what was actually incurred in 2020. And yeah, that equated to 40% of the effective gross income. I think that that's going to be the primary difference between the two valuations. We feel like we've lowered operating expenses on the pro forma side a necessary amount. Again, quite a bit below the actuals. And that's really going to be the bottom line difference between the two values. So, you know, based on the actual expenses in 2020, we feel that, you know, the $440,000 number is realistic in terms of developing an income approach value looking forward.
I do see that you've lowered here, or you say you've lowered your overall operating expense ratio to about 40%. Is that correct?
Yeah.
Okay. That is still, even as a generous estimate at 35% for market standards or parameters, that's still high. And, you know, again, the reason we use market parameters is so that we're not depending on no offense intended here, but we're not depending on individual taxpayers' assessment of what should and shouldn't be allowed and taken out or left in when a property is in the process of being renovated, for instance. So we can safely apply market parameter on expenses and come to a stabilized value from there.
Anyway, that's one of the big differences is between actual as opposed to market in terms of the way that the two pro formas were worked out, as I understand it. Was there any other questions or comments you wanted to make about her approach to this value?
Not for me, Mr. Williams, do you have anything?
I don't have anything further, no.
Charles, do you have any questions of either of them now? The assessor, I kind of had my chance to ask some questions of both of them so far.
Well, I've always got something, son, I start talking, and say something eventually.
We count on it. We count.
The $8 million just strikes me as being somewhat arbitrary and arbitrarily too low. So
was there a particular set of numbers in their pro forma that you felt inflated that deduction?
no, not really. I think the assessor's already made a good run at putting up the $11,078,000.
Well, I think the issue again conceptually, and I always say, yes, we got to do this, understand the problem from the property owner's viewpoint. You do have certain kinds of, you might say, one-time expenses, particularly when you're going through a rebuild like this. And many of us feel that it's important to encourage that. So it's not like we want these old properties to just disappear, so you've made that huge investment. The irony always is, well, you made that huge investment, you must think it's going to deliver a profit. You must think you're going to have a substantial return on that. And so that's always the irony when it comes, at least in my mind, before the board. So it's always I'm weighing, things and wondering, am I doing apples versus oranges here, or am I really working with numbers that are the same kind of numbers? So that's one of the issues from my viewpoint. The other issue is, I do think that, and that's the stabilization issue from my view. The other thing is I always try to understand how the market you are playing in, at what its general status is. It does seem to me that as we've looked at other downtown properties this year that have come before us in terms of the appeals, there's a lot of good data that suggests that downtown's value as a capital place to invest is trending upward, and that the assessor, when they try to, as she said it a couple of times in her, try to keep it all of you on the same competitive market, that they have to over these kinds of lower adjustments than perhaps your immediate costs are suggesting you're going to have to recover, and take you longer to recover for that reason. There's no question. So those are the kinds of things I always find myself doing. And we may end up like Charles and I often say, quizzically, but it's a serious thing. We're looking for equity here. We can't come up with absolute value numbers, even though in your pro formas you both have presented them to us. So Charles, are you trying, as we say, to split the baby here? Do you want to go down further than the 11 that the assessor is offering them? Or are you saying, no, I think that they've given them enough on this property, that they've invested this new amount of substantial capital investment, that they think they're going to get a return on investment over the years? Where are you intellectually on that?
If I were signing off, I would be saying 11,078,000. The taxpayer's asking for 8 million, down from 12.7, that's a 37%.
Sure.
That's just way too big in my mind.
Okay. What do you feel that, the question I raised about the immediate investment, though they've had to make it, therefore the cost they return, based on.
No doubt there's still something laying out there that's going to be recouped one way or the other.
Do we want to help them along? I know that we're not here to solve their business problems. We are here to help stabilize the tax base for the county. But I'm inclined to give them a little bit more than the assessor, not because I think Sarah's made an acceptable case for why they ended up doing what they did. But I'd be willing to look at something that's a little more like 10.5. So that gives them almost another million or two something. But is that too much? Am I just?
No.
That gets them to recover those costs quicker. That's all I'm doing.
I'm support 10.5.
Okay, then I will move that we adjust the fair market value today to $10.5 million even.
Second.
It's been moved and seconded to adjust further to $10.5 million as the fair market value on this property. We'll vote as the roll is called.
Dr. Ketchel,
Yes,
Mr. Van Willen,
Yes.
this is the fair market value set by the board this day. Gentlemen, I think that's all we can do for you today. Oh, well, I thought I meant on this property, that's all. Oh, no, you don't think, it has, Kirk's job is to keep be on target here. Okay, got that one anyway. There's the work now. Do I do what? Okay, thank you. And you're doing sellers. We're moving to the next item on our agenda, which is 1494. Again, let me read what this property is at 16 East Fifth Street, also downtown. And it was on previously for $4,500,000. They essentially believes that they should leave it at that. They're requesting it be corrected somewhat lower to $3,500,000. Essentially, they're making the same argument that they made on the previous one, and ending with their own pro forma income approach indicates that lesser value than Tulsa County. So I'm guessing we're going to look at two pro formas again on these two. And my hunch is the approaches to the pro formas will be very similar. Because consistency is not a hobgoblin for good minds. All right. Nevertheless, we will listen. Let's let you gentlemen begin with your presentation, and then we'll hear some.
Yes, thank you, yes. As stated previously, we believe the value of 3.5 million as opposed to the 4.5 million. The 2020 fair market value for the building was 2.639 million. We understand the 4.5 million is based on sales price. It's our position that the sales price includes some lease up and vacancies that have not been realized yet. None of the commercial space in the building has been leased. It's currently at 76% occupancy. We have, as you alluded to earlier, our pro formas on the second page. We have the direct cap income approach. Shows a gross income of $412,794, some change. Operating expenses of $206,547.04, giving us a net operating income of $206,247.50. A cap rate of 7.25% gives an indicated value of $2.84 million, which is similar to the 2020 fair market value. Under a pro forma income approach, potential gross income at $601,590. This is based on an 80% occupancy for the apartments, the residential side, and 20% occupancy for the commercial side, deducting the vacancy and collection loss. And operating expenses, we get to a net operating income of $268,852, 7.25 cap rate, supports the net indicated value of 3.7. The lease up deductions, I apologize, I stated earlier, the lease up deductions that come out at $238,000 gives us a net indicated value of $3.47 million. Similar to our previous packet on the very last page, we have the comparable equity analysis that we ran through last time on reunion. Currently, the net leasable area for Vandiver is at $121.05 a square foot, which is the highest net leasable area per square foot of all the buildings downtown. Again, to calculate the median net leasable area at $87.14 per square foot. The similarly adjusted net leasable income per square foot to $95, puts the reunion building at around $3.563 million and with the adjusted median price. Those are the three approaches we put forward. Mr. Williams, do you have anything to add to that presentation?
Please, do you wish to add anything?
No, I don't. Thank you.
You're welcome. Let me ask the one obvious question that the board always suddenly comes up. When was this property purchased?
February of 2020.
That's what I thought. See the
February of 2020.
2020. Quite often what we realize, I mean, in somewhat contrast to the other property we just went through discussing, which you had a little longer, you had to put money into and all that. But if it happens within that taxable year that you purchased it, even though it was a big jump from the previous assessment, there is that old rule that says if it's a willing buyer and a willing seller, they set a fair market value. And that is the rule of thumb that this board has used always in the past. And therefore, I'm inclined to, even without hearing Sarah, who I'm sure has worked up a wonderful pro forma presentation for us, inclined to say you set your own value. And we can live with that in the county, and the board can support that. Charles, am I wrong thinking that way, or are you?
No, I think you're.
Okay, then I'm going to shorten our hearing and say that I move that we accept as fair market value the one you have set in this recent purchase of $4.5 million. Is there a second to my motion?
Second.
It's been moved and seconded. We'll vote as the roll is called to sustain.
Dr. Ketchel,
Yes.
Ms. Van Wert,
This is the fair market value was set by the recent purchase. All right. Gentlemen, thank you.
Yeah.
for your presentation. Eric, before the
Yeah.
board.
By chance.
Thank you for your time.
You're quite welcome.
Thank you.
Bye-bye. I wanted to insist that somebody, we should turn up the heat. I bet I would fall on deaf ears, huh? Why is it public building roads? Yeah, why am I not smart enough to bring, I got long sleeves, bring a hand warmers or something. Okay, how are we going about this? We've got a call, and it's just one pack spread for the rest of the, okay. Thank you very much. Let's do it. Well, Sarah, I hope you weren't too disappointed.
No, I was ready to go on that.
Zach?
Is this Zachary Mitchell?
Yes, it is.
This is Ted Catchell. I'm calling you as chairman of the Tulsa County Equalization Board. We're here to hear via this telephone your appeals that are on today's agenda. You understand?
Yes.
Okay, that's fine. We have several. The tax assessor staff person is here also. I'm going to ask you to introduce yourself so he knows who he's talking with.
Yes, this is Tabitha Felts with Tulsa County Assessor's Office.
Okay, thank you. The first item on our agenda is 1527. Let me read what I have into the record here in the formal written statement, and then we'll give you a chance, Mr. Mitchell, to respond and add anything you wish. This property is at 23333 South Yukon Avenue. It was on previously for $2,705,298. The assessor is proposing to sustain that amount for another year. In his formal appeal, he says that he believes it should be reduced to $2,191,959 for the following reasons, requesting economic obsolescence. All right, Mr. Mitchell, please continue with your explanation.
Okay, do you want me to go ahead and walk through the packet or just provide a brief summary right now?
I think a brief summary will do, but you're certainly welcome to go through anything either in this presentation right now or later if you think we're missing something that you presented in the packet.
Okay, I mean, I was planning to just go through the packet prepared, if that's okay with everyone.
It is.
Okay, and to start out, I think this is I prepared two packets. I assume the one that everyone has in front of them at the moment is a 32-page packet.
I do have that, yes.
Okay.
First
and I can just kind of walk through this if that's okay with everyone, and then
yes,
if you feel free to stop me in the middle if you have questions, or we can circle back at the end of it.
That's fine.
Okay, perfect. And as noted, we have, just a quick overview. When I prepared this packet, what we're here today is we have 5 appeals that I'm representing under the National Oil Well Barco umbrella. I'll reference that as NOV. And then there's one additional appeal under Gardner Denver. I just say that because the NOV appeals for the 4 accounts, I included all those in the same packet of evidence. So I'll kind of go through that when I reference through the packet, but I'll point out which is for this specific account.
Okay, that's fine.
I did that, so didn't need to make 5 different packets because it's kind of all for the same reason.
Of course.
And we have appealed, to focus on the NOV packet, we have appealed 4 business personal property assessments for NOV. These are 4 subsidiaries within the NOV parent company. And the appeal is due to lack of recognizing economic obsolescence as part of the valuation, which I'll detail later in the packet. You can start on page 2 and 3 of the packet. This is straight from the NOV 10K financial document. It provides an overview of the companies that make up NOV. NOV, you can read through this if you want to, but just provide a high level. NOV is a provider of equipment and components used in oil and gas drilling and production operations, oil field services, and supply chain integration services to the upstream oil and gas industry. Detail more. We can kind of go through if you have any questions. You can go to page 4. As with many companies within the industry, NOV and its subsidiaries have taken a hit with the industry downturn that started back in 2015 and took another hit in 2020 with COVID-19. This is illustrated on page 4 with the total return on a $100 investment in 2015 with NOV and S&P oil and gas companies as a whole. And this is compared to the return you'd see if you put that same $100 in the S&P 500. As you can see, these companies have been hit hard with challenges that have really been industry-wide. And before getting into the company's specific obsolescence requests, I want to back up and discuss the valuation approach with this account by the Tulsa County. To arrive at fair market value for any asset or group of assets using the cost approach. The most common approach is to take the acquisition cost of an asset and then take the physical depreciation reduction from that cost based on the estimated useful life of the asset and then take how old that asset is at a given time. So if you have a 10-year-old asset, if you have an asset that lasts 10 years, obviously when it's roughly 5 years old, it's going to be worth 50% of the original cost that was paid for the asset. And this approach works for 99% of accounts. But it misses the mark in some cases where economic factors affect the value of an asset in addition to just physical depreciation. Economic obsolescence is the temporary or permanent impairment of the utility or sellability of a group of assets due to negative influences outside the property. In this case, the general downturn of the oil and gas market has negatively affected the asset value that we're talking about today. And if you go to page 7, this page is taken from the Oklahoma Tax Commission 2021 Valuation Handbook. At the top of page 7, it reads, all forms of depreciation, including physical, economic, and functional obsolescence should be considered as applicable to arrive at fair cash value. This is noteworthy because currently Tulsa County is only allocating a physical depreciation factor into their assessment. And the reason for this appeal is to request economic obsolescence adjustment be taken into account for this valuation. And I just want to say real quick that I 100% understand why Tulsa County may not allow obsolescence into their original assessed value. I understand that they're assessing thousands of properties in a county, and it's not an easy job to efficiently and quickly assess so many properties. And a straight line mass appraisal approach is often necessary. But that's why every taxpayer has the right to appeal and dive deeper into their assessment to try to arrive at fair market value. And I've worked a lot of these NOV accounts and other oil and gas accounts across Texas and Oklahoma so far for 2021. And just about every county has provided us some obsolescence adjustment because of the market conditions. Oklahoma County offered 25% reduction. Pittsburgh County has allowed 30% obsolescence reduction. Canadian County and Potawatomi County have allowed 20% obsolescence adjustment. And most counties in Texas have allowed between 20 and 40% obsolescence reduction as well. So our clients just a little not quite understanding why they aren't receiving a similar adjustment in Tulsa County. And so I just want to push that a little bit more, and that's why we're sitting down here today to go over these accounts.
I'm sorry, you just rattled off a group of percentages. I was curious, what is your impression of the percentage reduction for obsolescence that Tulsa County is operating with?
Right now, Tulsa County has not offered any obsolescence into the assessment, and I'll let them speak for themselves on that. I know they have a tough job to try to be fair and equal to all taxpayers, but I don't feel like a 0% adjustment for obsolescence at the end of the day gets to a fair market value in all cases. That's why we have built the property.
But you are testifying to the board that there's these other counties that you have experienced across Oklahoma, Texas, that do give percentage adjustments for these assets?
Yes, that is correct. And I mean, it is something that has been allowed in other counties, and to my knowledge is a approach that is allowed based on the Oklahoma Tax Commission Valuation Handbook.
Okay. I'm just curious, you may or may not know this, but what did Oklahoma County, the other large county in our state, do on this? Did they do a across the board percentage reduction for this kind of obsolescence?
Oklahoma County did a 25% obsolescence reduction, and that just to be clear, this is for equipment. This is not for inventory. Just notate that. So any equipment costs.
Okay.
Oklahoma County allowed 25%.
All right. Thank you. I appreciate the information. Go ahead with your presentation. I just was trying to tie something down in my mind before we got on to other issues.
Yes, that's a good point. And let me see. The account we're talking about is, do you mind bringing up that account number again? It's, is it the one that's in 2115?
Correct.
Okay, thank you. Yes, and so if you go to, I apologize, just one second. So if you go to page 12 of the packet and page 13, 14, and 15 as well, this shows the assessor work papers for this account, just for reference. You can see that they take the cost, they have an RCN cost times the percent good, which is the physical depreciation, which is how they get to their assessed value. Which we have no issues with the useful life. We have no issues with the cost being assessed on this account. So it, really is just the lack of economic obsolescence adjustment. That's the reason for the difference of opinion of value. And so just to kind of go through, I'll try to go through this quickly. I know it's a lot to look at, but starting on page 23, that really gets into our economic obsolescence support for these accounts. And when we look at economic obsolescence, it's a summary of factors we look at, and it averages out to 49%. I know that's an aggressive number, and some counties are lower, but it's just kind of a basis for where we are based on different economic factors. These are summarized. The factors are gross margin, and then we look at return on asset versus WAC, and then we look at return on inventory, WTI, and then rig count, which I'll detail in the next 5 pages. The big takeaway here is that the entire market is down. Interest in equipment and tools that relate to the market also take a hit on the values that they're sold, and these pieces of equipment are there for one purpose, and that is to make the company help make the company money. And when this equipment is making a fraction of revenue in production compared to earlier years, the ability to sell this equipment to other players in the market also takes a hit. So that's why we look at the whole entire market as a whole. You can see gross margins on page 24. When looking at other companies, including NOB, the average gross margin was around 25% at its peak, and in 2020 was closer to 5 to 10% as far as gross margins. For this specific data, this indicates an obsolescence of 42%. If you go to the next page, this is page 25. This measures WAC versus ROA. You all may be aware, but just to quickly summarize, WAC measures the required return needed to go through with an investment, whereas ROA is the actual return obtained via an investment. You can see on the second line at the top that this industry's actual average return on investment has gone from close to 6 to 9% as peak to under 2%, 2019 to 2020. To kind of quickly go to the next page, shows page 26. This measures return on inventory. I won't go into in depth unless you have questions. 27 is another metric that shows daily rates. And then page 28 is, looks at rig count. Active rig count in 2020 is down more than 50%. You can see rig counts have been dropping since back in 2014 as well. And so if you go to page 30, this is our opinion of value workup. It might be a little different than the bill because I worked this up after we filed the formal bill. But it takes the same, if you look at page 30, it takes the same cost. It takes the same physical depreciation, and we added an extra economic obsolescence factor after we take the physical depreciation, which is how we come up with our opinion of value. And then, and if you have any questions, let me know. But the main takeaway is due to the challenges in the market and just with really the industry being down for NOB and other companies, we try to take that account when we look at our opinion of value. And so that's why we're lower than the assessment.
And the overall, were you working with an overall percentage that you were reducing by then?
And the attachments provided, it's 50%, and that's based on the numbers in page 23. Again, I understand a lot of counties have not been that high, but usually it's been closer to the middle as far as 0 and 50%.
That was the number I was looking at on page, I guess it was 32. Yeah, your very last page. And that was what I was just trying to get you to confirm it for me. So that I had in mind.
Yeah, and again, this packet is for all accounts, all 4 accounts. So page 30, I believe, is the account we're looking at right now. The last page is a different account.
Well, actually, I was looking, I think it's 32 on this particular account, but I agree with you that the approach you're taking obviously is going to be very, very similar, even if the numbers shift. But the percentage was the reason I asked that question about percentage. If that's the one you're operating with, even if the numbers shift, that percentage is I assume you're steady as. Is that correct?
Correct, yes.
Okay.
The percentage doesn't adjust necessarily per account because it's more of a industry look as far as potential new buyer, that type of thing. So
Sure. Okay, let me ask one other general question, then I'm gonna let the Tulsa, or ask the Tulsa assessor staff to speak to this issue. But the general question is, are all these items on our agenda today that you're representing, are they all essentially these business personal properties in the oil business that you are representing? Or are you essentially saying all of these should be treated in the fashion in which I'm presenting to you right now, that there's not a big difference here from one to the other?
that is correct. They're all personal property. They're not dealing with any real estate appeals today. And they all take this, they're all under the NOB umbrella and take the similar approach as far as the evaluation on the equipment asset.
Okay, that helps us as a board to understand what we're dealing with, that's all. I appreciate your presentation, and I understand the argument about economic obsolescence that you're presenting. I admit, it probably doesn't surprise you, we've heard in past years this issue of economic obsolescence, and it's a very, very difficult one for both the assessor and for that reason also the board to figure out a way to deal with it fairly. But here we are again, and we will hear the presentation now from the assessor's office, and then we'll discuss it amongst ourselves before we make a decision. Okay, please introduce yourself for the record.
Yes, my name is Tabitha Phelps. I'm at Tulsa County Assessor's Office. I'll go over a couple of points that he made. And the Oklahoma Tax Commission does have guidelines that say that we should consider economic obsolescence, but doesn't say shall or must. So that's just a guideline. And we in Tulsa County do not recognize economic obsolescence because, again, we're need to be fair and equitable to everyone. So we just use a normal depreciation table. And to be fair, we have oil and gas here in Tulsa County, but these are the only oil and gases that actually this year protested and wanted economic obsolescence. And we are here to assess the assets, not really put an assessment or praise the actual business. We're just trying to assess the assets. And as far as Oklahoma County, giving them 25%, Oklahoma County hires a third-party appraiser called Task. And they are strictly oil and gas appraisers, and that's all that they do. And so they could have given 25% to all oil and gas. But in order for us to be fair and equitable, if we gave them economic obsolescence, we also have to do it to other oil and gas. And we just don't give economic obsolescence.
Now, go back, the point you were just trying to make, Bill, about the way Oklahoma County does it, that differs from the way.
They hire a third-party appraiser. They don't do, Oklahoma County itself does not appraise it. They hire a third-party appraiser called Task. And they're the ones that they do strictly oil and gas, and they appraise all their oil and gas for them.
So you're saying because we don't do that. That is, we don't identify the oil and gas industry as a one that should be dealt with separately. We're just dealing with them in the way we would deal with this kind of thing across all industries in
Yes.
our county. Is that correct?
That is correct.
Okay. Charles, it looks like we're dealing here with a conceptual difference in terms of the way that this industry, as at least represented today by this particular request for economic obsolescence, is caught in the bind that Tulsa County just conceptually doesn't do that. They think it's unfair to try and do it. I know we've discussed this on other businesses. I can't remember where last year we dealt with oil and gas or not, but what do you think about this argument? Are we preparing to plow into some new ground here, or are we stuck with the fact that our county just has this other approach and we either support them or we don't?
Well, first, my overall thought is, how are you able to control or manage this? You guys have got a county to run. And economic obsolescence, okay, I get to reduce the tax base, is that? Apply the rate. It's just so nebulous that I'm uneasy with it.
I see.
It's not legalistic one way or the other. It's just, this county can choose to use economic obsolescence. County next door doesn't have to, and you guys, Tulsa County doesn't consider it.
We don't consider it. I mean, like I said, the Oklahoma Tax Commission guidelines say should, but it's not a shall or must, and so our county chooses not to.
So the taxpayer in this case is not totally far afield in pulling this economic obsolescence in. It's just that Tulsa County doesn't consider it.
Because we'd have to consider it for everyone, I mean, not just one certain company.
Would say again now.
We don't, because we're doing we're mass appraisal, and we're doing it the same for everybody to be fair and equitable, and we can't just give economic obsolescence to one company or one sector and not another.
It's that debate over, as I hear it anyway, again, it's the debate that the oil and gas industry want, in some sense, the county to treat them differently because of the way they face issues in their particular business. And this county, Tulsa County, says, no, we can't do that because we don't do that with any other industry. That's the way I understand the argument.
How would Osage County do it?
Well, seemingly Oklahoma County gets out of it by hiring somebody else to do it for them. I don't
Do you
know.
mind if I add something?
Please,
Yeah,
I'm sorry.
Leave me out of the wilderness here.
Yeah, I'm not laughing about your real economic pitch. I'm just trying to
Oh,
understand.
I just had one correction to note, if it's okay. It was noted that Oklahoma hires a third party. I noted 4 counties, Potawatomi County and Canadian County does hire a third party, which is TAS. The other 2 counties I noted, Oklahoma County and Tulsa, not Tulsa, let me see, it's Oklahoma and Pittsburgh County. Those 2 counties have allowed obsolescence, but they do not allow a third party to my knowledge. I've worked with BART at Oklahoma County, and Pittsburgh County is also not a third party. I just had to point that out. It was Canadian and Potawatomi County that were third parties.
Okay, thank you for correcting the record.
So if we
Charles.
subscribe to economic obsolescence here, do we have to blanket go across and apply it to every taxpaying entity out there?
Well, that's the position Tulsa County is taking, as I understood the staff statement. Is that correct?
Yeah, I mean, in order to be fair and equitable, I mean, I think you would have to do it. If you're doing it for one oil and gas, I would think you'd have to do it for all oil and gas. If they're all having the same issue, but nobody
And
else.
so is Tulsa County doing it in every case?
We don't give economic obsolescence to anybody.
Okay, fair enough.
In other words, I have heard this one before, obviously, but I've always wondered if the only way that your client, Mr. Mitchell, or the industry could win on this one, Tulsa County, you're gonna have to take them to court and get the court to say where it says should, you're required to do it, as opposed to the interpretation that I'm sure the Tulsa County lawyers have given the assessor, which you don't have to, because that's not the way the law is written. But that's
If I can-
just a passing comment. Please don't quote me on that too further, okay? But yes, go right ahead. We need to wrap this up for you. Go right ahead.
Okay, this is a closing comment. I totally understand from a master appraisal technique, Tulsa, they have to do what they have to do. And they try to get the fair value as effectively as they can. And I understand that. But a lot of counties do not allow obsolescence on the initial assessment, but that's where the taxpayer has the right to file an appeal. And then at that time, they usually allow a standard obsolescence per that industry. Like in other counties, it's a set 25% or 20% is not really negotiable. It's just kind of based on what your company type is, that type of thing. And then they allow that after you file the appeal and kind of look at everything in more detail.
So you're
And
saying,
at the end of the day, the job, I understand that the job of, this hearing and everything else is to try to arrive at a fair market value regardless of really anything else. Really at the end of the day, regardless of what the initial assessment was put at for whatever reason, we feel it's only to arrive at a true fair market value. There is a true need for an economic obsolescence adjustment.
understood. And what you're saying is the board still would have the right to say we disagree with the policy and try and create some kind of economic obsolescence that's within our legal right to do. I don't disagree with you about that. Charles, where are you on this one?
I would move that we sustain.
Okay. I'm afraid that has been the policy of the board in the past years also, that we have not been comfortable with the idea that we should declare an economic obsolescence when the assessor's consistent policy with all is not to use it in this county. So I will support that. Charles, if you move it, I will.
I move that we sustain.
Okay. I'll second that motion. We'll vote on this particular appeal, which I believe is going to set the tone for the rest, but this one is 1527, Emerald International Court, ZAC. We'll vote as the roll is called to sustain.
Dr. Ketchel,
Yes.
Mr. Van Willen,
Yes.
So ordered by action of the board to stay. Mr. Mitchell, obviously, unless you have some particular evidence that would suggest the other items on the rest of our agenda that you're representing today are in some material way different than the one we just ruled on, I think we would simply go ahead and vote individually on them to sustain, but please speak up if you have some other issue.
So it's kind of two different parts. There's 4 accounts that are under the NOV umbrella, and then there's 1 account that's under the it's a different client, different enterprise, Gardner Denver, and they kind of ends in 1437.
Yes, well,
The
let us.
other 3 accounts for NOV, they're all the same exact argument, so we can kind of skip through those as far as I don't have anything to add on those accounts. With the Gardner Denver account ends in 1437, I would like to kind of look at that one up just briefly. It's just briefly, I'd like to discuss that one separately.
Certainly we will. Let me go ahead and vote on the other four just to get the agenda straight, okay? We've dealt with item number 1527. We're going forward now to deal with item 1528, which is also the Amaran International. Here, we can keep all this together, I know. Okay, if I just, what do you want me to do? Sustain and you'll do it, or you want me
No,
to?
you'll need to write on each one.
Each one, okay. We have acted on the first one. This is the fair market value. We have sustained that one, 5-0. Next item on our agenda was similarly 1528. It is also the Amaran International Court. They were on previously at 15,061,341. The proposal from county was to sustain. They were requesting, however, that this one be reduced from that number to 5,216,037 for economic obsolescence. I move that we sustain the 15,061,341 for a similar reason. Is there a second to my motion? Second. We're moving to sustain. We'll vote as the roll is called.
Dr. Ketchel,
Yes.
Mr. Vanderwood.
Yes. This is the fair market value. Item number 1529 on our agenda today, which is Fiberglass Systems LP. That was previously on for $2,546,051. The assessor asked us to sustain that. The appeal was that it be corrected for economic obsolescence to $1,1,619. I'll move to sustain. Is there at the $2,546,051? Is there a second to my motion? Second. It's been moved and seconded to sustain. This is the fair market value. We'll vote as the roll is called.
Dr. Ketchel,
Yes.
Mr. Vanderwood.
Yes.
So ordered by action of the board. Our next item was 1530. It is the Containment Solutions Incorporated. Was previously on for $3,952,447. That was proposed to be sustained by the assessor. The request was that it be corrected to $3,248,785 for economic obsolescence. I move that we sustain, rejecting the argument of economic obsolescence. Is there a second to my motion to sustain?
Second.
It's been moved and seconded. We'll vote as the roll is called to sustain.
Dr. Catchell,
Yes.
Mr. Van Dwellen,
Yes.
This is the fair market value. Mr. Mitchell, we have reached that item that you would like to present some other information about. That is Gardner Denver's. And they are item number 1531 on our agenda today. Please. It's on currently for $22,155,032, and they are proposing the assessor to sustain it. We have those documents in front of us now. Mr. Mitchell?
Okay,
Yes.
yeah, just since it's different enterprise, I just want to kind of go through it's a totally different evidence packet. I know it won't matter, but if you want to, on page 3 of this packet, it goes through kind of everything this company does as far as the background. And then
What would you
this
say
company
is the,
as well has a challenging year, and they furloughed a bunch of employees in 2020 as well as shut down the facility for a period. You can see on the same economic obsolescence adjustment is not granted in the assessment. You can see on page 15 the most up-to-date production numbers for this facility. They were down in 2020 versus 2019 and was operating at a fraction of the full production capability, which is why we're asking for obsolescence on top of the economic indicators summarized from page 16 through 21, which is the same from the earlier discussion on NOV. And that's how we get to our opinion value of $13 million provided in this packet. Again, much of the same arguments that we went over in the NOV account apply to this account as well as far as the economic indicators. That's all I have here.
and how would you generalize, describe what is the difference you're wanting us to take into consideration about this operation? Is it a different kind of operation than the ones you've been presenting?
It's not necessarily a different operation as far as, I mean, it's the same, for the most part, the same argument as far as the industry obsolescence, economic obsolescence request. It's just the main difference here is we do have some site production numbers to go over. That's 100% on page 15. And but if the economic obsolescence is outright not allowed, I don't know if it'll make a material difference on the appeal.
Sure.
But this company has struggled with many challenges as far as production and revenue and other factors that I wanted to point out, and this is provided on page 15. And the company summary is on page 3 if we'd like to review or discuss anything, as well as the financials on page 6.
Okay.
Yeah.
Charles, do you have picked up anything that you think we should?
Yeah, I see no difference here. What we just worked our way through.
Okay. Because of even if they have some difference in operations, the fact that they are faced with economic obsolescence in terms of their actual equipment that they're operating with. Still falls within the consistent county's operation to say this is still economic obsolescence and we just don't consider that. Is that your opinion?
Yes, it is. And the county literally does not consider it at all anywhere, any place.
No, we do not. And I did want to also point out, I mean, I'm sure they are having struggles, but on their 2021 rendition that they filed, you should probably have this, they added $8 million worth of assets last year.
They what?
They added $8 million worth of assets last year. So I mean, you would think if they were struggling, they'd be getting rid of some stuff, not adding 8 million, but
That make any appreciable difference in the, you didn't change, you
No, it's
didn't
still-
raise their.
no. I mean, they got normal depreciation, but they're from last year to this year, their number did go up because they added that, you know, that much in
So it
assets.
did count against.
Yeah, it was still depreciated, got 1 year worth of depreciation. It was new assets, so
Yeah.
it's not.
And therefore, the assessment of the current value represents that percentage.
That
Well,
those new
well,
assets.
Just that, yeah, just to quickly note, on page 7 and 8 of the packet, there was a merger with Gardner Denver and Fall Ram, which I think would probably account for a lot of the additions. Just wanted to quickly note that.
Sure.
Carry on.
All right, Charles, make the motion.
I move that we sustain.
It has been moved to sustain, again, rejecting the argument of economic obsolescence as part of a way of evaluating these. And I'll second that motion. We'll vote to sustain.
Dr. Ketchel,
Yes,
Mr. Van Willen,
Yes.
this is the fair market value for this business personal property. All right, Mr. Mitchell, I think that's finishes our agenda with you today.
Yes, and thank you for everyone's time today, and hope y'all have a good day.
Thank you very
Thank you,
much.
sir.
You have a good evening. Goodbye.
Thank you.
I think we're still on the phone there. Somebody needs to turn it on. Hate to say something untoward. Oops.
It's on.
it's on.
It's on.
Is it?
Yeah, the lights are green when it's on.
All right, I believe I can move that we have finished our agenda. It is time to vote to adjourn. I so move. Second. It's been moved and seconded. We'll vote as the roll is called to adjourn.
Dr. Ketchel,
Yes.
Mr. Van Willen,
Yes. So ordered by action of the board. We are adjourned.